When it comes to acquiring a new car, there are several options to consider: financing, buying, or leasing. Each method has its own advantages and disadvantages, and understanding the differences between them is crucial in making an informed decision that aligns with your needs and financial situation. In this comprehensive guide, we will delve into the intricacies of financing, buying, and leasing a car, providing you with all the necessary information to make the right choice. Financing a car. Financing a car involves obtaining a loan to purchase the vehicle, with the loan amount being paid off over time. Here's how the process typically works. Applying for an auto loan. To finance a car, you start by applying for an auto loan. The loan application process usually requires providing your personal and financial information, including your credit score, income, and employment details. Lenders will evaluate your application and determine the interest rate and terms of the loan based on your creditworthiness. Making a down payment. When financing a car, you are typically required to make a down payment. The down payment is a percentage of the car's purchase price that you pay up front. The amount of the down payment can vary depending on the lender and your creditworthiness. A higher down payment can result in lower monthly payments and may even help you secure a better interest rate. Monthly payments and interest. Once your auto loan is approved, you will be responsible for making monthly payments to repay the loan. These payments consist of both principal and interest. The principal is the amount borrowed, while the interest is the cost of borrowing the money. The interest rate on your loan is determined by factors such as your credit score and the length of the loan term. Building equity in the vehicle. As you make your monthly payments, you gradually build equity in the financed vehicle. Equity refers to the difference between the car's value and the amount you owe on the loan. Over time, as you make payments, your equity in the car increases. This equity can be beneficial if you decide to sell the car or trade it in for a new one before the loan is fully paid off. Ownership and freedom. One of the significant advantages of financing a car is that you become the legal owner of the vehicle once the loan is paid off. This ownership provides you with the freedom to keep the car for as long as you want, modify it to your liking, and even sell it whenever you desire. Unlike leasing, there are no mileage restrictions or wear and tear charges to worry about. Pros of financing a car. Financing a car offers several benefits, including: you become the legal owner of the vehicle once the loan is paid off. Unlike leasing, you are not limited by mileage restrictions and can drive your car as much as you want. As the owner, you can customize and modify the car to suit your preferences. You have the flexibility to sell the car whenever you choose. Cons of financing a car. Despite its advantages, financing a car also comes with some drawbacks, including: monthly payments for a financed car are usually higher compared to leasing. As a car owner, you are responsible for the depreciation of the vehicle, which can result in a loss of value over time. Financing a car means you are responsible for all maintenance and repair costs. Buying a car. Buying a car outright involves paying the full purchase price up front, without the need for financing or leasing. Here's what you need to know about buying a car. Paying cash. The most straightforward way to buy a car is by paying cash. This involves using your savings or liquidating other assets to cover the full purchase price of the vehicle. By paying cash, you avoid monthly payments and interest charges. Negotiating the price. When buying a car, you have the opportunity to negotiate the price with the seller. This can involve researching the market value of the car, comparing prices at different dealerships, and using this information to negotiate a lower price. The ability to negotiate depends on various factors, including the demand for the car and the seller's willingness to make a deal. Ownership and freedom. Similar to financing, buying a car outright provides you with full ownership and freedom. You have complete control over the vehicle, including the ability to sell it, modify it, and drive it without any restrictions. Pros of buying a car. Buying a car outright offers several advantages, such as: you have immediate ownership of the vehicle. Buying a car with cash means you don't have to worry about monthly payments or interest charges. You have the freedom to drive the car without any mileage restrictions or wear and tear charges. Cons of buying a car. While buying a car outright has its benefits, there are also some drawbacks to consider. Buying a car with cash requires a significant upfront investment. Like financing, buying a car outright means you are responsible for the depreciation of the vehicle. As the owner, you are responsible for all maintenance and repair costs. Leasing a car. Leasing a car involves renting a vehicle for a specified period, typically 2 to 3 years. Here's how leasing works. Upfront costs. When leasing a car, you are required to make upfront payments that include the first month's payment, a security deposit, taxes, and any additional fees. These upfront costs are typically lower compared to the down payment required for financing or buying a car outright. Monthly lease payments. Instead of making loan payments, you make monthly lease payments to the leasing company. Lease payments are typically lower than loan payments because they only cover the depreciation of the vehicle during the lease term. The exact amount of the monthly payment depends on factors such as the car's value, the lease term, and the agreed-upon mileage restrictions. Mileage restrictions. One of the key differences between leasing and financing or buying is the mileage restrictions. Leased vehicles often come with mileage limits, typically ranging from 10,000 to 15,000 miles per year. Going over these limits can result in additional fees at the end of the lease term. Therefore, it's important to consider your driving habits and estimate your mileage needs before deciding to lease a car. Wear and tear charges. When returning a leased vehicle, the leasing company will assess the car for any wear and tear beyond normal use. If there are any damages, scratches, or excessive wear, you may be charged additional fees. It's important to take care of the leased vehicle and keep it in good condition to avoid these charges. End of lease options. At the end of the lease term, you have a few options. You can return the leased car and lease a new vehicle, starting a new lease agreement. You may have the option to purchase the leased vehicle at a predetermined price, which is often called the residual value. This allows you to keep the car if you have grown attached to it or believe it still holds its value. If you no longer want the vehicle, you can simply return it to the leasing company and explore other options for acquiring a new car. Pros of leasing a car. Leasing a car offers several advantages, including lease payments are typically lower than loan payments, making it an attractive option for those on a tight budget. Leasing allows you to drive a new vehicle every few years, enjoying the latest features and technology. Most leased vehicles are covered by the manufacturer's warranty, reducing the cost of maintenance and repairs. Cons of leasing a car. While leasing a car has its benefits, there are also some drawbacks to consider. Lease contracts often come with mileage restrictions, which can limit your freedom to drive as much as you want. Excessive wear and tear on the leased vehicle can result in additional charges when returning it at the end of the lease term. Unlike financing or buying, leasing a car means you don't own the vehicle and must return it at the end of the lease term. Factors to consider. When deciding between financing, buying, or leasing a car, several factors should be taken into account. Here are the key considerations. Budget. Your budget plays a crucial role in determining which option is best for you. Consider your financial situation and determine how much you can afford to allocate towards monthly payments or a down payment. Driving habits. Your driving habits and mileage needs are important factors to consider. If you have a long commute or frequently take road trips, leasing with mileage restrictions may not be suitable for you. On the other hand, if you drive less and prefer a new vehicle every few years, leasing might be an attractive option. Desire for ownership. If owning a car outright is important to you, financing or buying would be the better options. Leasing does not provide ownership unless you choose to purchase the leased vehicle at the end of the lease term. Long-term versus short-term commitment. Leasing is a short-term commitment, usually lasting 2 to 3 years. If you prefer to drive a new vehicle frequently and don't want the long-term commitment of owning a car, leasing might be the right choice. However, if you prefer to keep a car for a longer period, financing or buying would be more suitable. Future plans. Consider your future plans and how they align with your car ownership goals. If you anticipate major life changes or plan to upgrade to a different vehicle in the near future, leasing allows for more flexibility. However, if you prefer stability and the ability to keep a car long-term, financing or buying would be a better fit. Comparing financing, buying, and leasing. To provide a clearer understanding of the differences between financing, buying, and leasing, let's compare them side by side. Conclusion. Choosing between financing, buying, or leasing a car is a decision that should be based on your personal circumstances, budget, and preferences. Each option has its own set of advantages and disadvantages. Financing allows for ownership and flexibility. Buying provides immediate ownership without monthly payments, and leasing offers lower monthly payments and the opportunity to drive a new vehicle every few years. Consider your needs, driving habits, and long-term goals to make an informed decision that aligns with your financial situation. Remember, There is no one-size-fits-all approach, and what works for one person may not work for another.